again, Swaby here, Swaby States, and just doing another episode. I'm just kind of following back up on where we are now in the real estate and economic cycle, and how the market is looking today, especially now with a rate cut of 0.25 basis points from the Bank of Canada. This happened last week. Obviously, this is welcome news. Any little bit helps, and of course, under the circumstances with the amount of renewals coming in this year, definitely it is a concern for the Bank of Canada and a concern for our economy. Now, this 0.25 basis point rate drop obviously is one of the first rate drops we've had in over 4 years. Last time there was a rate drop was in 2020, and since then we've had obviously COVID, we've had our circumstances with economics in terms of everything being shut down and reduced to a halt, and then everything going kind of digital, and then from there real estate markets really picking up, since those were the one type of thing that you could do during those times. And of course, with that running up inflation, supply chains being obviously thrown off by all the lack of inventory and people being able to produce these things, lots of buyers, just not enough supply, and people being able to work, of course, is why we're kind of in this position in the first place. And of course, lots of spending. So with that being said, the 25 basis point rate cut that we just got from the Bank of Canada, obviously welcome news. Of course, the best part about that is we at least can now officially confirm that we're at the end of a business cycle. So with that being said, there's a couple things. Obviously, there's room for concern if the Bank of Canada is dropping rates. There's always that, you have to factor in the fact that there's a reason why they're starting to drop the rates at this point. Now, obviously, inflation, we're at about 2.69% on the last read. For Canada, that's really good. Obviously, the Bank of Canada and as well as the Federal Reserve has a mandate of 2% is what they're looking for in terms of mandate. And going in the trajectory of that 2% is their goal. Obviously, they don't need to acquire 2% before dropping rates. They just want to make sure that it's going in that direction. They have enough data to at least quantify the reasoning for dropping the rates. In this case, Canada, obviously our economy is not as well as the U.S. economy at this point, and obviously our economy is dragging. We don't have a whole lot of growth whatsoever. Actually, we're pretty stagnant in terms of growth right now, which is also going to be another reason for concern as things stagnant. Obviously, there's no transactions or lacking transactions thereof, and of course, productivity is dwindling. So obviously, something needs to be done. The Bank of Canada has seen this as an opportunity at this point. We feel comfortable with the data enough to start dropping rates, of course. Now, this is one of obviously many rates that will probably proceed after this, but in the period of time right now, he wants to go by data. Obviously, that's what the Federal Reserve and the Bank of Canada have been stating for some time, is they're going to be basing all this information on data, and as the data extends further and we find out that the inflation is still coming down and the trajectory of the inflation is still leading towards that 2%, they'll continue to drop rates. If you were to listen to, obviously, Tiff Macklin, he'll better elaborate in terms of his feelings towards everything and the trajectory that he intends to continue down, of course, as long as the inflation data comes in the same way as anticipated or better, of course. Now, obviously, economically, we got to be being mindful of the concerns in economics, because obviously with GDP that's basically virtually flat, and it's been this way for almost the past 7 quarters. Obviously, there's concern there. There has to be some kind of reinflation of obviously GDP has to start growing again. We need our country to start growing again, and the only way that's going to happen is with obviously rates have to come down, because right now we're in a restricted territory in terms of rates. This is what they call when they want to try to reduce activity in the economy. So by reducing rates, obviously that's going to start to stimulate back obviously the activity and economic activity in the country. Now, of course, 0.25 basis points is not enough to stimulate very much. The most that 0.25 basis point reduction is going to do for us is give us some at least clarity in terms of direction, or at least a better clarity. And at least at this point, we know that we're at the bottom of the cycle, and we're going to start going back into the recovery phase, assuming everything goes accordingly and we continue to drop rates. Now, that 0.25 in terms of a mortgage, to kind of give you perspective, is really about $13-14 on a mortgage per 100,000. So it's really not going to tip the scale in terms of Everybody running back to the market trying to buy a house because everything is just so much better now. No, it's actually going to take some time. You won't see very much change in a 0.25 basis point rate reduction. You're probably going to have to see at least 0.75 to 1% before it actually starts taking effect. And then, of course, in real estate, the market's a bit slower. It's not like the stock market. Stock markets are pretty rapid. They tend to be speculative in nature, obviously, in the sense of which people already price in something that's coming in the future. So they're anticipating things. So that's why the stock market tends to move a little quicker than the real estate market. Is usually a lag of 6 to 8 months at minimum. And that's for it to take effect on what's occurring today. So even a 0.25 basis point reduction isn't going to do much overall. And then, of course, it will take 6 to 8 months before it actually reflects back into the data, as there is a lag effect in real estate. So obviously we need more rate reductions before it will actually affect our market to a great deal. We'll get some people off the sideline thinking, hey, rates are coming down now, maybe I should jump into the market. Sure, maybe a few people will start making some moves because, of course, with the rates coming down, asset prices are usually correlated opposite to the cost of servicing, right? So if rates come down, then the asset prices tend to go up, and that's just the cycle, and that's how it works in terms of asset to obviously cost relation. When we're talking about, you buy a house, you're a rental property, do you do the math? Does it make sense for you to purchase this property based on a certain interest rate relative to a certain amortization period? And can you pay these payments, or can you acquire the rent required in order to cover these payments? And that's the big thing. And right now, these numbers just don't work unless you're going into multiplexes. Then at that point, you could probably try to make it work. Obviously, you have multiple incomes, less risk, and risk is more diverse. But if you're an individual with a home or a condo and you're trying to make sense of this math and you're trying to make it work with the cost of borrowing, it just still doesn't work. So the investor still is not inspired to go out there and purchase a house today, unless, of course, you're speculating on the future and the rate drops to build value in your asset over time. Then yes, it makes sense because you're trying to get in where you can in terms of getting deals today. Sure, you'll pay a little bit over the time at the beginning because you're trying to, of course, get in at a good asset price. And then later on, as rates come down, your asset price will inflate, and then from there you'll make property value versus the actual cost of servicing the debt in the meantime. So it really just depends, obviously, in terms of the investor and what strategy you want to approach. If maybe it's your first property, it makes sense to take a little bit of the burn today, but at least you get a really great price on an asset before prices start to balloon. Now, obviously, it's going to take a lot of rate drops before ballooning starts happening, and of course, but things will start to move upwards, obviously, as rates come down. And of course, with that being said, when it comes to investment, our economy, of course, cannot thrive at high rates. Obviously, it's restrictive. Most people are not doing anything. Most people are struggling, actually, and not to mention the people that are coming into renewals. They haven't even felt that pain yet. And this is happening, a lot of which is happening this year, hence why I would imagine the Bank of Canada is taking these precautions, because the debt levels are really high in Canada especially, and of course a lot of people and delinquencies are rising, of course. So there's a real concern in terms of our economy, and of course if he were to damage the economy because we kept rates restrictive for too long, especially when people are renewing, you're going to get a lot of pain in the market, in an economy. Trying to build out of that, especially after it's been kind of destroyed, is a very hard thing to do. Last thing we want to do is go into a recession or a really bad depression. So of course, now with regards to politics, there's a lot of things happening in politics. Obviously, there's a new capital gains tax that the federal government is trying to implement. Of course, 2/3 will be taxed now on capital gains, and capital gains is when you're essentially doing any kind of an investment with regards to capital and trying to make a capital gain from it, usually within a 12-month period minimum, or else it becomes an income. So in that period of time, what the federal government now is trying to do is they're trying to tax a 2/3 amount as opposed to 1/2 amount of your capital gains, assuming you make over $250,000. Now, again, they're using the branding as this is the very elusive 1%. The rich people, the people who have the most money in Canada, which of course it does not mean that you're rich because you had an asset that you made over $250,000. Now, that could easily be an inheritance from a family member. Maybe they built that wealth throughout their life. It took a whole lifetime to build that wealth. They pass it over, boom, you're hit with capital gain tax. Oh, it's over 250. We're going to take 2/3 on taxes now. We'll not take 2/3, but they'd be taxing on 2/3 as opposed to 1/2, which also makes that thing very difficult. But more importantly is how that affects things. Is if you are looking for an investment in your country and the investments coming into the country are big capital gain expenditures, then you're going to reduce the amount of people who are interested in coming into the country to make these capital investments because there is now an additional barrier. So it doesn't mean people won't come in, but certainly you think about it, especially now if it's going to be more expensive for you to do so. So again, trying to encourage more investment and then trying to tax the people that are going to come in to do more investment is very difficult. Or just in general, like I said, you can have properties, you can have assets yourself. Maybe you're a big stock market guy, you make money and you make over $250,000. Well, guess what? Now it's 2/3 they're going to be taxing on and no longer 1/2. So that's obviously a big implication. Now, the federal government also is trying to implement housing and trying to stimulate housing, affordable housing, and that comes up a lot, affordable housing. Now, the problem with affordable housing is especially in a time right now, they want to increase affordable housing, but then the cost of borrowing is so high. How can you stimulate people to build? How are builders going to come in and want to build affordable housing when it costs too much to service? The people that are buying these investments typically are investors. Investors can't make sense of the money right now. And if you can't make sense of that, then how are you going to stimulate more development for more housing, to have more housing for people coming in of course, immigration? They wanted to change the policy on immigration or trim it down, but they just keep, adding more to it. Obviously, the immigration policies keep changing, and there's still lots of immigration coming into the country, and that immigration is a good thing overall as long as you have the right people coming in. But if you're just opening the doors and onslaughts are coming in, well, then that's where a lot of the pressure's coming from, because there's a lot of demand for housing, and there's not enough housing being built. And of course, you want to stimulate housing, but then you're knocking people with capital gains. Now you're going to tax more on that, and then of course the cost of borrowing so high, but investors can't afford to make sense of the investment, so the investors are sitting on the sideline, and then builders are going to sit on their hands because, well, there's no investors to build these things. And then of course costing and holding the costs while we're waiting for projects to get done is costing a fortune. So it's a very big stack of problems that need to be, of course, rectified before we can get all this stimulation and all this economic activity out in the market. And it's going to take some time. We're going to need some interest rates to be dropping some more before we can actually make sense of the numbers in terms of as investors. You need investors to come back to the market to actually have a reason to invest and, of course, want to make the money and buy into these investments for the builders to then build out these and stimulate these investments. So, and then there's, of course, there's affordable housing, and then the government now is issuing a catalog book of prefabricated homes from the war era, in which post-war era they were building out prefabricated homes in order to stimulate more housing as quickly as they could, and this was kind of like their solution to the plan was let's build out a catalog so people have prefabricated home options. I'm pretty sure most people aren't looking for prefabricated home options, but hey, that's the solution to the problem right now. And then otherwise, budgets with regards to the government in terms of spending. I know there's a $40 billion projection or anchor. They were trying to anchor a $40 billion in terms of deficit, and ironically, the projection right now is showing a $50 billion deficit. So these guys are just spending like crazy, and it seems like even their own anchors that they're trying to set for themselves aren't sitting tight. They still seem to keep spending. So obviously, in the whole period of time, I would almost say a decade, the whole 8 years or so that this government has been in place, our economy has really just been pretty flat. Not a whole lot of growth or change. I mean, there's been some dabbling in between, but unfortunately, this economy, our country, Canada, which has obviously got a great, vast amount of resources. It is a beautiful country overall. We just have a lot of problems that has to be solved. before this country can be flourishing as it used to. And unfortunately, we have some time to wait before that happens. And of course, a lot of these things can't happen without the capital investment. And it has to come back to rates have to come down so that there's more affordability. Obviously, people are struggling. The last thing people are thinking about right now is investments when they're struggling on their mortgages and struggling to live, and everything costs a lot, right? So we have to get to that place where rates are back to at least an average range where we would say it would be maybe 2-3% would be realistic. Obviously, I don't expect rates to come down to where they were, say, 2.5 years ago. Those were incredibly low rates, but we probably will get back there one day. But for now, we have to get to an average range where things make sense again, and then of course we can stimulate growth. Obviously, we have an election year in the U.S. That's coming up very shortly. There's a lot going on there. Economically, the U.S. is definitely doing better than Canada, but there are some cracks that are starting to show, of course. The consumption levels of the last readings have been coming down, although their production still running wild, and of course their job numbers are still getting filled. So they're not at a reduction in terms of jobs, and there's not a high job loss number yet, but you're starting to see some changes there as well. And then of course, with Canada deviating from the US, there's going to be a bit of a currency gap. And as we reduce rates more and more and the US stays firm, there'll be a bigger gap in terms of our currency and our trade. Will get affected a bit. It could be a good thing. Obviously, we could, obviously GDP wise, we could push out more products and more for them to buy at a lower cost. But of course, when we export, our dollar is a bit weaker. But again, that's what segregates the two countries, and these things do happen. It is normal in terms of cycles. What we would hope, though, is that the U.S. at some point is reaching their targets and the direction they're looking for as well, so that we can kind of realign at some point again. Give or take, probably could get away with a 1% to 1.5% before it really affects our currency. But ideally, we would hope that things will change before then. And of course, other places in the world, like the Europe obviously is looking in terms of their banks, in terms of reducing rates as well. So we're not the only country in the position to have to reduce rates. But we are all getting there, and it seems that trajectory is going down to that 2% overall. Some things are just going to take a little more time, like the U.S. But the good news is we're on the right path towards what we're trying to achieve, which is that 2% of what the Bank of Canada's fiscal policy is about. And we are getting there, and the rates have started dropping. This is the good news. It has started dropping. Maybe it's not enough to do anything substantial yet, but we are on the right trajectory, and that's what matters the most right now. It gives us a little bit of hope. So ideally, right now, again, the economy, we're seeing everything on a day, on a meeting to meeting basis, on data to data basis. We'll continue to look at the data. We'll continue to watch how the economies play out, and of course we'll continue to watch the real estate market. But as it stands right now, the real estate market, obviously there's been a fair amount of slowdown. The detached market is still moving, as long as you're not an incredibly expensive detached home. If you're in the townhouse market, you're probably still doing okay. If you're in the condo market, there is a lot of inventory, and a lot more inventory overall is building up. Our market has slowed down relative to what most summers would typically have in terms of listings. There's a lot more inventory sitting on the market. Houses are sitting a lot longer. There was a time houses wouldn't sit longer than a week to 2 weeks max. Now we're seeing houses sitting for 30 to 60 days, depending on, of course, where the price is and if they're willing to negotiate or adjust pricing. So our game change, our ballpark here will change, obviously, as things change with our policies and such. But we'll continue to look at it, and hopefully this video finds you well and informs you. I'll give you a little bit of information and insight on what's going on economically right now in terms of Canada, a little bit on the US, of course, and how that affects us. But we'll continue to put this out and see how this helps everybody in terms of making proper decisions in terms of investments, and of course in real estate, what I do and focus on the most. And again, thank you again for watching. If you have any other questions, feel free to put some questions in the comments. I can always answer that for you, and we'll see you the next time.